Hi everyone, welcome to Enterprise Tuesday. I'm Bob Wardrop. I'm going to chair this evening. I'm trying to look to see if I get some familiar faces. I teach in this room, so I'm expecting, of course, to see a bunch of familiar faces. But this is very nice. We're joined here tonight by Scott Button from Unruly, who's going to talk about his exit. But before we get to that, I want to introduce Sean Grady from AstraZeneca, who's going to take a few minutes to talk about basically a science competition, in effect, right, that you have going on that's kicking off today. And Sean is a Vice President of Business Development and Operations at AstraZeneca, and he leads the transaction execution, due diligence, alliance integration management function, including early stage and on-market licensing and partnering, M&A and divestment, so he's busy. During his career, he's worked in roles for ICI, Zeneca, AstraZeneca, in corporate pharmaceuticals, US legal departments, HR, and business development. And his major projects have included the AstraZeneca merger, the creation of Avicea, Sagentia, acquisition of CAT, Medumin, Emylin, and the spin-out of Albireo. So with that, I'll pass it over to you, please.
Thank you. Yeah, I did all of those things single-handedly, which explains why I've got grey hair. I'm only 23. So thank you, Bob and Scott, for just allowing us 5 minutes of your time before the proper part of the evening starts to announce the opening of the period for admissions for the AstraZeneca Startup Science Competition, which opened today. So I'm the head of business development in AstraZeneca, so I'm one of the now 2,800 people who've moved to Cambridge over the last 4 or 5 years. So we're starting to feel that we've been here for a long time. But of course, compared to the 800 years of Cambridge's existence, we're but the blink of an eye. But when we arrived in Cambridge, we didn't actually want to be the big pharma who read out lists of all the great deals you've done before you get hold of a microphone. And we thought quite long and hard about how do you enter a well-established, sophisticated life science and fintech and other ecosystem, and how do you play a proper part in that cluster? And one of the things we hit upon with our friends here from the Judge Business School was actually assisting startups and entrepreneurs with coaching and mentoring as an opportunity to be a good neighbour with our new neighbours in Cambridge, to help the startups, but interestingly, additionally, to actually develop AstraZeneca people. Because when you're in a 60,000 person company that operates in 127,000 countries, getting the ability to work with startups on pitching decks, on finance plans, just kind of thinking in an entrepreneurial way is actually quite unusual for people like us who work at scale. So we saw benefits to give to the community, but also benefits that we could take back into AstraZeneca and kind of cross-pollinate entrepreneurism into the company, if that doesn't sound too corporate and or pompous. So since we've arrived, we've got a mentor pool of about 70 people from all different scientific and business and other disciplines. And that mentor pool have worked with over 90 startups and entrepreneurs, mostly in Cambridge, but also further beyond in the UK, and we're doing a similar thing now in Sweden, and we're just starting a similar thing in China at Wuxi and potentially in Beijing. So from a few conversations here in the business school, this thing's kind of going global, which is both pleasing and worrying in equal measure. So having made coaching and mentoring a key part of our arrival strategy, the next obvious thing to do was to have an AstraZeneca branded startup science competition. So we had the first one last year. As you'd expect, great success. Attracted some really great entrants. We had 3 fantastic companies in our final. Callium Diagnostics, you may know, Tanya and her team were the winners. And as I've said already, today we are launching version 2, the second year. So applications open today. The closure for applications is the 14th of June. A reasonably sized number of companies will be shortlisted to come in to the company and pitch to a panel of esteemed judges. The judges are drawn from the company, but also from the business school, from Babraham, from Lucy Cavendish College, from Pitch at the Palace, the elevator platform organisation where we help and support the Duke of York's entrepreneurial support programme. So a nice, diverse group of judges, from which, again, 3 companies will be selected and, if agreeable, attend to pitch at the final. And the final will be at an event we call AZ Exchange, which is, here at the Business School on the 3rd of July. And there will be probably something in the region of 250 to 300 guests, external guests, at that event, which will be the usual fantastic array of angel investors, of VC, of private equity, of big pharma. The great and the good of Cambridge and beyond will all be present on the day. So a perfect opportunity to pitch to some of the most influential people in the Cambridge Life Science cluster. So I'm conscious I'm pitching to people about a pitching competition. I hope it hit the mark and would get good votes had it been an entrant into the competition. My colleague David is here with me as well. We're both going to stay for the, no doubt, exciting and illuminating evening, and we'll be around later on to share a little bit more information. There are some information forms around and about, but mostly it would be great to talk to a few people if there is interest, either in the competition or in working with AZ mentors on any particular topic or aspect of your business. So Bob, that's what I had to say. Hope I didn't take up too much time.
Perfect. Thank you very much. You can keep that. Thank you. Okay, so on to the main event. Scott. So let me just say briefly, I teach here new venture finance, and I teach to MBAs and master finance students, and also a course called FinTech Strategies and one called Alternative Channels of Finance. So my space is sort of more FinTech and finance technology than advertising, but I appreciate sort of the technology. And I also have been involved in a number of exits as an investor, as a director, personal investor, professional investor over the years, before really coming into academia about 10 years ago. So I straddle the worlds, but I've never done anything that Scott has done, not even close, right? So I think this will be a really interesting evening. I'm very curious about exits. I've wrestled with a lot of these issues from a perspective other than the founders. So I think this is going to be really valuable. And Scott was a co-founder of Unruly, which is the global video advertising marketplace acquired by News Corp in 2015. That must have been interesting in itself. Before launching Unruly in 2006, Scott was the CEO of Connextra, which was a venture-backed UK ad-serving firm. He holds an MA from Cambridge, he was over at King's, and a BPhil from Oxford, both in philosophy, useful for the ad business. Yep. And previously did short spells. I noticed the short spells in the House of Commons and McKinsey, and won Ernst & Young's Emerging Entrepreneur of the Year Award in June 2002. So what I'm going to kick off, I think the way we'll run this, that I'm comfortable with, I think it's more interesting for the audience. I'm going to talk a little bit just to kind of set the context with Scott, because I think context is important whenever you're going to start to talk about exits and exit strategies. But very early on, I would encourage you to jump in and start asking questions that you think are interesting and relevant to why you're here. We haven't highly structured a big rehearsal and a big scripted thing. I think we're both very comfortable with going fluidly with how the audience would like to take this. And my job is to kind of steer that and kind of help Scott respond so that everybody's really getting something out of this. So I'm just going to, again, start off by talking a little bit about context. I think, Scott, you had started a business back, Connextra, right?
Yep.
Talk a little bit about just the inception of this one, how the founders got together, just to start to set the stage a little bit on some of the dynamics that fit into kind of the thinking about exit.
So Unruly had 3 co-founders. So there's myself, Sarah Wood, who is also my partner in life as well as business. So we saw a lot of each other and still do. And then Matt Cooke, who was the 3rd co-founder. So he was the CTO of Unruly. And that's someone that I'd worked with at my previous business. So we were both very early employees at the Connextra ad-selling business that you mentioned, Bob. So we'd known each other for 5 or 6 years. At that point, Sarah and I had been married for about 10 years. So we all knew each other sort of very, very well at the get-go.
Yeah, and you exited that in a form. Talk a little bit about that exit.
Oh, sorry, the Connextra exit.
Yeah.
Okay, so that was small beer, but important because I kind of cut my teeth doing that. So I wasn't a founder of that business. I was probably employee 9 or 10, and I ended up running that business. We raised a little bit of capital to get it through a difficult period, because it was a real kind of classic dot-com boom and bust company. It had raised money, like a decent amount of money on a wing and a prayer. I remember interviewing there, and they had 23 different revenue models, which of course meant they had 0 fucking revenue. So anyway, we managed to turn it into a bit of a business, and we did make some money, and we exited that in 2000, sort of late 2005. Largely because we were just keen to kind of move on and do the next thing. So I had a bit of equity from a tiny amount of money I put in. Well, it was all the money I had at the time, about £5,000 or something like that, and some options. But that exit got us out about 300k sterling, which is
real money in those days.
In those days. It wasn't that long ago. But yeah, I mean, it's enough. It was enough to see this, basically, because you often see, and I still get dismayed by this. You see a couple of good founders with a good idea, and they end up having to give away 20-40% of the company, within the first year when they're really just getting going, because they've got no finance whatsoever. So as we thought about it, that was to give us 2 years runway, because we weren't paying ourselves. So we basically had 3 co-founders, all in a position, fortunately, and willing and able to work without being remunerated, and then a few $100K in the bank. So we thought, well, we can probably figure something out in a couple of years.
Yeah, so you went into that without necessarily having the big idea. Mm-hmm. You had, as you put it though, you had runway, right? I mean, you bought that flexibility to basically buy the independence and the time to find your way along.
Exactly.
But you got to a point where you did raise some money.
We did, yes.
Talk about that.
So that was quite a lot later. So we founded in 2006, and we run off the initial investment, and then we were cash flow positive within 2 years, which was the plan. And so we did another then 3-4 years just growing off of cash flow. The raise we only really did one raise, one institutional raise, which was beginning of 2012. So we'd kind of run for 6 years by that point. Now we were off. We used to get bore ourselves silly discussing this internally, because you're always thinking, well, shall we raise money, shall we not? It's quite scary, growing a business, because we grew that business to be quite big. When we raised money, I think we did 17 million sterling that year, and about $1.5 million EBITDA. When we did that raise, we hired like a professional CFO in. And it was just, and I think you often get this dissonance when you start hiring in, like proper finance people. So the dissonance was, I would go to the ATM and put my cash card in. I remember once there was, I think it was £600,000 in our bank account, and I'm like, yes, this is really cool. And the CFO came in and went, oh my God, because he did his cash flow projections and was like, you're going to be bust in 6 months, and we weren't, because but we were seat of the pants, and we had maybe we had enough in the bank usually to cover about 3 months of OPEX, which is, not the sort of thing that a CFO is comfortable with. And we were wanting, so that's one of the reasons that, there were a few reasons why we wanted to raise money and why we did it then. One was because...
So let's keep track so everybody's tracking. So how many years in are you now?
6.
You're 6 years in. Were you constrained in growth at all in terms of the self-generated cash flow to grow the business? Did you guys feel like we could grow faster if we had more cash? Or talk about some of the factors that were feeding into the decision to raise outside money. Because at that point, right, you're kind of, well, you can talk about the implications of that in more detail.
Yeah, so, were we constrained? Yes. You're always constrained, even if after you've raised a bunch of capital, you're still constrained. I think we needed that money to kind of professionalize some areas of the business that we were under-investing in, knowingly under-investing in. I think one of the issues you have as an entrepreneur when you are literally just trying to run the business by the skin of your teeth, and you've got money coming in, money going out. So we really, we were very happy to hire software engineers. We're a technology business. That felt like a good investment. Really happy to hire salespeople, because they would generate revenue. Was really happy to hire, a few biz dev people who would go and cut deals with media partners.
That's revenue.
Also revenue. IT, finance, legal, HR. They don't generate any money. So, we had, so that the wheels didn't quite fall off, but it was getting pretty close. We were 6 years in, reasonable scale business. I think we had about 60, 70 staff. We had one guy who was doing finance, HR, legal, and also, tech infrastructure. You've got lots of engineers around, but it's like who actually makes sure the phone systems work and the salespeople. So we had literally one guy doing everything.
And then he died, and then...
Well, it made doing the raise kind of interesting because they wanted to see where all the employment contracts were.
Yeah.
We're like, well, they're in that filing cabinet over there, aren't they? And we're like, somewhere and some weren't. So I think we got the most helpful thing about raising institutional money is the sort of professionalization. So we had to start running proper board meetings, and we had to start documenting stuff. And we did put in place proper HR, proper legal, all that sort of stuff, because otherwise we wouldn't have been able to exit. 3-4 years later, because it would have just looked like a shit.
No, there is this notion being exit ready, right? It's really important, and I think it's one of the first steps that an institutional investor will take investing in a business. They'll start thinking about how they're going to get out and what needs to be in place from a due diligence perspective on that ultimate exit. Was that fair?
Yeah, no, totally fair. And probably it's a good reason also for thinking about, even if you don't need seed funding.
Yeah.
So we were just a bit arrogant and we're like, well, we don't want any VCs on until we absolutely have to. But then, of course, we didn't look very professional when we were going out, so we had a decent-sized business, but, and we ended up getting, a lot of good offers from the European VC community. I did go out to the US. Nobody was interested because we were just like this weird UK business that no one, there wasn't an institution in it already. They just didn't know what it was going to look like on the inside. And to be fair, it did look messy on the inside, and they didn't want to be dealing with that as a lead investor from 6,000 miles away. So I'm thinking, because we would really have liked a value investor in when we were doing that round, but we just didn't have the credibility, honestly, as a team. And some of that is just like the rubber stamping of, and if you've got an institution in, people know the governance is likely okay. It's not a guarantee, but it does increase the probability, yeah.
Yeah, and I think that the different institutional investors are operating in different governance environments with respect to how their limited partners will look at the fund, and the liability issues are very different. If you're running a fund in the United States versus Europe too, although that's to some extent globalized. But you also were facing some other issues in terms of raising that round that were motivators. Can you talk about that more from a personal point of view? Because, you know, founders have to have discussions about whether we do, whether we don't. You've described the business reasons.
Yeah.
But there's a personal side.
No, absolutely. So, I mean, from a personal standpoint, the main reason that we took institutional funding at that phase in our journey was so that we could take a little bit of money off of the table. If we hadn't been able to have done that at the time, we wouldn't have done the round. I mean, honestly, from in terms of motivation, that was the single biggest motivator for doing it. Because, you know, at this point, you know, you're 6 years in. We've, you know, been working like crazy at this thing. We're still not paying ourselves like market rate salaries. All our net worth is tied up in this thing. So the ability to take like a bit of money off the table, you know, really quite important. Because, you know, again, we would talk about, you know, timings of exit, because we could have sold the company, you know, around about that time. I just thought it was too early and we weren't really being ambitious enough. But, you know, if we weren't going to do that, we were going to kind of like, you know, have another roll of the dice, do another 3, 4, maybe 5 years, however long it is, then at least we could de-risk a bit, you know, pay off the mortgage, not worry about paying, you know, school fees and all that sort of stuff. So that was the primary kind of personal motivation for doing it.
How did that discussion emerge among the founders? Because it's an interesting founder dynamic in this case. You've got 2 people in a romantic relationship. I assume it was still romantic at that point. And I'm referring to you and Sarah. And you have a third, you had Matt.
Yeah, in the complicated love triangle.
Well, you never know. It's the ad business. Yeah. And so what was that, how did that discussion emerge, and were you aligned in that? Because it's not, you could make a case, it's not necessarily, you're in different situations, right, within the 3 of you, or not?
Well, so Matt was about 5 years younger than us, but, you know, was married, had kids. And it's not like we kind of like would have a big kind of sit down power about this stuff. We'd just kind of, I think we, you know, certainly with Sarah and I would just communicate like all the time. And then with Matt, you know, again, you just have like quite a lot of touch points, honestly. So there was never a big moment where like, right, okay, we need to sit and do this. Because actually we were talking about fundraising and primary and secondary. You know, we were talking about this like, you know, every time we would meet up, honestly. So I think we were, you know, fortunately, quite naturally aligned. We didn't have any big differences of opinion or POV on that. I mean, Matt, well, yeah, I mean, you know, there have been a number of occasions where he's been sort of ambivalent on a decision, but happy for it, you know, he just wanted to kind of get his head down and you know, write code and build a team that would build great software. And, you know, it was very rational. I mean, if you say, well, you know, and this is why it's going to be good, you'd kind of get him. So there wasn't a lot of emotion around it. You know, there was discussion, in particular bringing the third co-founder along on a decision. It was very, you know, ratiocinative.
So you're in a partial exit, right? You're taking some money off the table. Mm-hmm. You had did you retain an advisor to do that? Did you have a banker doing that deal for you?
Yes, yeah, we did.
And was it a boutique? I mean, and how did you source? Word of mouth?
Yes.
Interview 5 of them? I mean, what was that process? Because that's really an important relationship.
Yeah, so I think I talked to probably about 5 or 6 different you know, investment banks or advisories. Yeah, at that end, they're quite boutique. So Torch Partners, who we used, they did a bit of Series A fundraising, but they're really more focused on M&A. So we kind of went with someone a bit larger, a bit more experienced, because there were plenty of, you know, very boutique, you know, firms that are quite small and just do kind of Series A fundraising round.
Yeah, and the Series A is different, right? People aren't necessarily taking money off the table in a Series A.
Yes, unusual in the Series A. I mean, it's A because it's the first one we did. I mean, it looks, and it has some of the characteristics of a later round.
Yeah, and was that an issue, taking money off the table? I mean, as a general principle, investors don't like money coming off the table. But, they can. But how did you frame that, or your banker frame that?
So we were very upfront about that. We probably had it in our use of proceeds. But no, we were very upfront. And we found people, at least superficially, were quite open to that. No one explicitly blew us out over that particular issue. Now, people still blew us out, so you don't know what they're saying, behind closed doors. But I was quite surprised, actually, that we got quite a good reception to that most people kind of got it and were like, yeah, we're backing this. We want to do something bigger with this business. So let's not have the founders having sleepless nights about, paying rent.
Yeah, and you still had, if I understand correctly, if I recall, you still owned, the three founders still owned a controlling interest in the business.
Correct, yes.
Yeah.
We retained, yes, I think after we'd done that round, we had 75%.
Yeah, so you got a lot of incentive.
And we were very clear that we wanted to retain board control as well as having kind of shareholder control too, which we did manage to achieve.
That's a good deal.
Yes, I mean in terms of.
I don't know the other terms, but
in terms of
what you want
framing tonight. I mean, yes, it actually got us partial exit.
Yeah.
But with about as much independence as you can get. Now, obviously, you bring in VCs and they've got these veto rights and there's terms over here. But we had shareholder control and we had board control, which I just think some people will tell you that you don't need board control. I mean, lawyers will often say, it's all by consensus. Well, it's all by consensus until you fall out.
It's true.
So I always thought psychologically for us it was quite important to know that if anything ever did go nuclear, we were in a pretty not inviolable, but in a pretty strong position. So
the period from the partial exit to the exit, what's going on during that period?
A lot. So raising money is actually quite easy. It's not easy if you have to keep doing it, which is what lots of businesses do. I mean, we're lucky we only had to do it once. So we raised and then could kind of focus on building out the business. But then, then you've got to deploy it, right? So we were already in, I think, about 5 or 6 different markets at the point at which we raised. So we were already in the US and already in a few different European jurisdictions. So really it was just about turning the gas up. So we turned up the gas quite a lot on the US in particular and also on engineering and product. So having the capital, as well as just doing the boring kind of housekeeping stuff of, making sure people have got employment contracts and you've got, a functioning HR department. It was really build up the engineering team, build up products. We built up quite a lot of product in that time and did quite a lot of kind of geographical expansion, which is, which is why you need all of these kind of core boring functions to actually be, reasonably well oiled, because otherwise things just start blowing up.
Yeah.
It wasn't plain sailing. It's almost like a law of raising money that your business goes bam, 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 and as soon as you raise money, you'll miss the next quarter. Always happens. It's happened to us too.
So how soon did let's start talking about exit. When did that conversation start after the 2012 raise? I mean, did this start pretty early? You've now got institutional money in and they're thinking fund return.
Yeah. So it wasn't a board conversation with the VCs over, really very much for the first couple of years, I would say, because we just needed to execute. And, when you're trying to scale a business up like that, so, over the next kind of 3 years, we scaled from 60 staff to 250. And we're in, I think, about 19 offices that those staff were spread over. So, it's a major headache. So a lot of business complexity. So there wasn't much explicit discussion, not until certainly probably 2014, I would say.
Okay, so you're 2 years post the raise.
Yeah. Now, there's always the expectation, right? I mean, once you bring institutional money in, this probably isn't going to be a, run it forever and hand it over to the kids business. You really need to create some liquidity, and what the kind of life cycle of a VC fund is. So you've got quite clear timelines. And we knew, I think we had 3 funds come in. 2 of them, I think, were investing quite late in terms of their the life cycle of the particular funds that they were using to deploy from. So we knew they were going to be like a little bit less patient than more patient. And there were some things built into the terms of that institutional raise that incentivized us to exit or would penalize us for not exiting around sort of 2015, 2016.
So did you have an IRR hurdle that was a trigger, a ratchet of some kind, or I'm sure it's private and all that, but just give us some idea of what that mechanism might have been.
Effectively, so there's 2 things. So it was quite a strange. The terms were quite strange. I mean, there weren't sort of standard US VC terms. So on day 1 there was no participating pref, but participating pref did accumulate a little bit.
I see.
Over the time period. So the longer we went to exit, the more participating pref there would be for the VCs. And then there was actually like a small dividend cash kicker that kicked in about 4 years, I think after 4 years. So there's a bit of carrot and there's a bit of stick actually. So so I think it's sensible. They made it kind of like really, really super clear what sort of time frame they would like to see liquidity within.
Yeah, so that participating pref, do people know what that is, by the way, as an instrument? So you can have different share classes. I think this is worth knowing because there's actually different kinds of pref shares, right?
Yeah.
Participating pref is a particular type of a preference share that gives you the right, as if you had converted that preference share into a common share, to share the proceeds of being a common shareholder at exit, plus you get the repayment of the preference share value, and it has usually a dividend associated with it that compounds.
Yeah.
And so pretty quickly, your indebtedness to pay that dividend increases on a compound rate over time. So that was some of the time pressure.
That was some of the time pressure. Yeah.
And these are mechanisms that investors will use, right, to drive the return that does create, to some extent, some short-termism potentially in terms of when you want to exit. Because otherwise, the common shareholders are giving more and more to the pref, to the money that came in a compounded sense. And those, depending on what your rate was, whether it was 8 or 10 or 12, but it's not usually 3% compounding. Okay, they're usually pretty aggressive.
Yeah, it's material.
It's material.
Yeah. I mean, a standard, kind of participating pref, like a US VC, it would just be like 1x upfront, right? So they put in 10 mil. Whenever if you exit,
liquidation preference.
Yeah, exactly. If you exit for 10 mil, guess what? Only they get their money back because they get the 10 mil back before anything else gets divvied out. So it wasn't, it was much friendlier than that. But there was clearly a ticking clock.
Yeah.
And it didn't force our hand, but it's clarifying, isn't it? And then the other key thing to talk about from an exit timing standpoint is really your your market timing, like where your kind of product sits against market and competitive landscape, because it might sound stupid, but the technology behind advertising has changed very rapidly and very chaotically over the last 10 or 20 years. And although it's possible to describe kind of Unruly's product and its journey as being a kind of very smooth, continuous transition or evolution, we really had to reinvent that business kind of twice. There were probably 3 distinct phases of it, and those, the business model of each of those phases looked quite different. So, we could have exited around the time we did our institutional raise, 2011, 2012. We had a great business at that point. It was going all out. And there was quite a lot of excitement and froth in the market, and some of our competitors got bought out. That would have been a good time to exit. We raised. And then actually a lot of dynamics in the market shifted. And we can go into detail or not. It might bore people a bit, the nuts and bolts of it. But we had to reinvent that business, and we kind of knew that it was going to be probably 3 or 4 years before we'd have a moment again when our kind of product market fit looked sexy, and you're kind of the right point on the hype cycle and all this kind of stuff. It's all kind of true and real, but it's like surfing. I mean, you've got to kind of you're waiting for the wave, right? Your timing on this stuff is really critical, and so I think we did manage to time our final exit quite well. Because again, if we'd waited a couple of years beyond that, we again went into another phase of business reinvention. Because advertising was becoming much more thoroughly kind of computer centric in terms of how the actual trading mechanics, the buying and selling of advertising.
Yeah, I like that analogy of the wave surfing and catching the next wave. And there's 2 aspects to that. One would be investment in driving a return on the investment required to do almost a rebuild.
Yeah.
Right? So you got to get your ROI if you're going to make that investment to transition. But the other one is more the business model shift and the uncertainty of pulling it off.
Yeah.
How would you weight those two? Because, how did you see that? Was it the financial risk, or was it the business model risk? Where you guys, essentially, it sounds like what you said is, boy, do we want to go into this again?
So I think the uncertainty risk is much higher and more difficult, and it's like the driving factor here rather than around, because your uncertainty levels are so high that any model that you build out, like your 3-year plan, your 5-year plan, I mean it's just BS. Yeah, you can build one, you can build 5, you can make it say whatever you want to say. You know how easy it is to 3 assumptions on the
spreadsheet,
assumptions page in your Excel, like woo. So you can always make and I know this post-acquisition as well, going through budgetary processes with a corporate parent, you can always make your spreadsheet do what it needs to do. But as a business person, as an entrepreneur, I know that your uncertainty is so great that even if you've got models going here and here, you could still be under your worst case and you could still be above your best case, and you're still frequently facing issues that are existentially threatening to the business.
Yeah. So I'm conscious that we've been talking for half an hour, and I've got lots of questions because we're now going into the final exit phase. But I'd really encourage anybody that's got any questions, if you want to start asking questions now, from here on in, feel free, because I think we've got, the base of this sort of bedded down a bit. We've got questions. Okay, please.
Hi, yeah, I'm curious as to the valuation method, not the number, but the methodology that was used in the first round, where you had a profitable business with a quite a good revenue. And how did that conversation evolve?
So at the time, businesses in our domain were typically valued off of either revenue or gross profit rather than off bottom line, because we were actually extremely unusual in the fact that we were turning profit. Most businesses in the advertising space, and it's absenting Google and Facebook, it's still the case now. There were lots of businesses that were growing quickly but not making any money, and then the question is, well, at what point do you and can you, and if you hit a certain point of scale, can that profitability start looking quite good? So we were profitable, but we weren't valued off of our EBITDA. And of course, as soon as it's one of the things I still find a bit weird. You raise some money, if you're going to, unless you've got capital projects, and very few technology startups really have capital projects, the only way you can deploy that money is by going unprofitable, for a period of time, and then you kind of got to, come back out of it. So anyway, chiefly it's a multiple of revenue, although some people would think about that as a multiple of gross profit, which is probably a more sensible metric than the pure revenue-based one.
So we're coming up to, yep, please.
You talked about sort of redoing the tech twice. So what was the intrinsic value of the business? Was it the contact list, or just knowing the industry, or what?
So, I think when and kind of jumping forward a little bit and thinking about, what was the intrinsic value to News when they acquired us, it's actually relatively soft stuff, like, know-how. So, we had at that time, 250 people spread across a bunch of territories. We probably had one of the most sophisticated, like, digital ad sales teams. Facebook's was, where are we now? Yeah, Facebook's very sophisticated. Google's very sophisticated. But outside of them, we had really, really good teams and some really interesting kind of tool sets as well that were kind of built into our, because your core product offering in tech is often a little bit boring. You just got to have the right features and the right features. But then, well, what's the interesting stuff that you're doing beyond that? And we were doing some at the time, really quite interesting things around testing long-form branded video content and looking at emotional response to that and creative testing and lots of nice little nuggets that we had from a sales standpoint. So lots and lots of know-how. Yes, there was a technology platform there that we had built out over 10 years. It had been iterated a number of times. How much intrinsic value you can put on that kind of stuff? Because you have to you have to keep moving so fast. If you stop developing, that value dissipates in our industry over 12 to 24 months probably. So the stuff there that you need, but it wouldn't have lasting value without the kind of all the ecosystem of the people around it, if that's helpful.
Jeremy.
Thank you. Really helpful talk. Thank you, Scott. Bob. Might be part two of the talk, so I might be jumping with the questions actually. You mentioned current valuation based on multiples. Presumably the exit valuation was not based on multiples. Is that a fair assumption or not?
No. Most of the discussion and negotiation at the point at which we were selling to News was still around revenue and gross profit multiples, actually. I think even Rupert, who is not really one for revenue multiples, but he had a number in his head, and the number in his head was some particular multiple of revenue, because we were still we were kind of borderline break even at the point at which they acquired us. So we were profitable, we'd taken a bunch of investment, we'd gone into investment mode, we were just kind of coming back out of that, and we're pretty much break even and just edging into profitability at the point at which that acquisition happened. But so you can only really do it off of the only meaningful metrics you've really got there financially is the revenue or gross profit, however you want to look at that, and the kind of the growth rates, the trajectory of that. So, we did have to submit quite detailed, I think, 5-year plans probably, showing our profitability post-AC, but it wasn't done on, EBITDA or any form of kind of asset valuation. It was really just off of a revenue multiple, and that's what we were arguing about. They had a low one and we had a high one, and we ended up somewhere in the middle.
Now this is interesting because this is Sean's world, would look at whether something is accretive or dilutive. to some extent. But Sean, in your world, this would be relatively small in News Corp terms, right?
Yes.
But were they still looking at accretive versus dilutive and trying to get their head around whether what the synergies were going to do in terms of making this accretive? Or was it just rationalized strategically where it's not?
I think it was too small in terms of, in like the scale they had. It was, I think deemed immaterial from a share price standpoint. Because at the time, so you had News Corp. So News Corp had all of their newspapers, all of their content behind paywalls, right? And with some of their titles that had worked quite well, and some of the titles that had worked less well. So the point at which they were doing the acquisition of Unruly was one where they were just about to take some of their titles out from behind the paywalls. Now what that meant was, they had spent 3 years, 5 years, whatever, whilst, the digital ad economy was kind of doing things where they just hadn't built out any sort of capability really at all around digital ad sales. So, that's kind of that, there was a clear strategic imperative. They were just going to launch, so New York Post, The Sun, they had a few other businesses, but quite, they were going to like put them into public domain, take the paywalls down. Suddenly they were going to be like, they were going to grow these big audiences through search and social, and then, they would need to build out quite a big, strong, kind of executional function around, ad sales, ad management, and the kind of the tech stack that underpins that. So, there was something that they really didn't have, and that's why I say, a lot of it is about know-how. We injected quite a lot of know-how into that company at that time.
Okay, so is that a question? No. So you're 2 years before. You sense we're on a wave.
Yeah.
This wave is cresting.
Yeah.
And we're going to face a challenging decision about possibly business model shift and certainly investment at some point in the not too distant future. And this focuses really the discussion between you and whoever else is on the board about should we be looking to exit here. Is that a fair characterization?
Yeah, it is. And I think, I'm saying, because whilst the terms of the institutional deal, give you the sound of a ticking clock in the background that's quite clear, that wasn't really the driver. If we, as the founders, had thought, wow, we should do another raise, we should shoot for here, we would have done that. We were all, you're constantly taking risks, and you're constantly taking often quite stupid risks as an entrepreneur, and are constantly overconfident. But I think, what we saw really very clearly was the sort of the increasingly dominant position that Google and Facebook were taking in the market. I think it took quite a lot of people quite a long time to realise what was going on there, and maybe people even now don't quite realise. But so Google and Facebook between them take 70-80% of digital ad revenue. They take virtually everything. Every year that the economy around digital advertising grows, say it's probably going about 15% at the moment, their growth rate will be 20, which means that they're sucking up every single dollar of growth, and everybody else is in decline.
Yeah.
And so, as a small indie, we thought we really, really needed to align with, a large media company. Didn't have to be news, but we just wanted to have more power on our supply side, because what we were selling is inventory, and we wanted someone that owned a lot of inventory. If we didn't own any inventory, we were just selling other people's. And it's a constant dance of business development and contracts and sales agreements and yada, yada, yada. So we were pretty clear that we needed to have more power on the supply side and to be part of someone that was bigger. And of course, News Corp still looks very small compared to Facebook and Google. It's been really interesting. It's one of the reasons it's worked as well, because we were quite underdoggy, and you join a large corporate after acquisition, but you're still with the underdog, and they do have kind of quite good scrappy underdog spirit, which I quite like.
Yeah, and I mean, this whole thing of if you want to see a brilliant analysis of the advertising market, there was a competition in digital markets report just done by the UK government. I think it's called the Hutton, but somebody here at Cambridge was and they actually have a brilliant graphic, I think it came out about a month ago, of showing the share in the UK advertising market.
Yeah.
And you see these blocks, and you just see Google and Facebook and these other little tiny.
And there's nothing else really.
It's extraordinary.
After that. And that's.
But you spotted that, right? You saw that coming, that train coming.
Yeah. Well, we got. We were quite sensitized to it. Because Google caused us quite a lot of pain. They did try to kill our business in the sort of mid-teens. So it's one of the things that made our post institutional investment quite tough, because Google, YouTube, really came after us like really very, very, very aggressively. And we had to dance around, pivot a bit to kind of sidestep that sort of onslaught. So we knew how like really, really ruthlessly aggressive they were, and we saw similar things with Facebook as well. They'll bring you in and they'll wine you and they'll dine you and they'll want to talk partnership, but really they just want to kill you. And we've seen this,
It's the movies played out over,
because the sort, if you're News Corp and you've got all these titles, for various reasons around search and social, you can't really afford not to ally with these people, but they're really not your friends.
Yeah. We had a question, right? Please, right here first. Yeah. Interesting market.
Yeah. Very, very concentrated. Yeah.
Hi, thank you for that. At the time of founding, did you and your co-founders have any clear idea of timeline and exit, or would you have kept on surfing that wave hadn't it been for Facebook and Google? Was it ever, for example, an idea that you might, like you say, create a kind of company that you would pass on to your children, or did that never even come on the?
No, we did. We were at the very outset. We were quite open around these questions, and in fact, if you had asked me at about around the time of founding, you'd have found me quite allergic to the idea of taking external investment and to exiting. Just largely for emotional reasons. I'd just done one exit with my previous business. Exiting a business is really, really horribly painful. Not because you're, letting your baby go into the world. I mean, people think that, but I mean, no, it's just the sheer amount of, it's so much hard work. It's so much negotiation. Everyone you thought was this, is very, very lonely. Everyone you thought was on side suddenly is on their own. Everyone has their agendas. And I just, and it was a really small acquisition. It was only like, it's a couple of mil. And, but didn't have much support. We had a, small law firm from, I don't know, Banbury or something working on it. Didn't have a banker. And, there are just moments when it gets really heated. And this is where it's quite useful to have, good advisors who can intermediate a bit, whether that's NEDs on the board, whether it's advisory banks, because there just are moments when you're kind of locked in the heat of it, and people tempers fray, things get said that are quite hard to forget. So yeah, I just done a small exit, but I thought, oh god, that was really hard. So I was like, no, never doing that again. We're just going to build a forever company, and then we can pass it on to kids. But anyway, we also didn't know what company we were building when we started out. We was like, we'd just done one thing, but we didn't found it, so we didn't really quite have the whole entrepreneurial journey. We thought we could do that. We knew we wanted to do that. So we were just like, okay, we're going to do it, and we'll kind of figure out what we're doing on the way. And so the same thing really is true around the exit and investment stuff too. We were just constantly kind of feeling our way, and a lot of it is around timing. We'd had lots of, we had investment offers before we went to raise institutional. We just didn't think they looked, that good, or the timing wasn't quite right for us.
Yeah. I'm keeping an eye out for hands. Yes, at the back, please. Thank you.
Thank you very much. I'm just trying to find out, people say do what you're passionate about. Do the business you're passionate about. If you're passionate about anything, you would not want to let go of it. So how does that square up if you really started Uber and now you see Uber growing to a multinational company and then you want to float Uber and sell it and not get trapped in the same quagmire that Steve Jobs found himself when he got Appleized out of Apple?
Yeah, it's a really interesting question, actually. So, I mean, a couple of answers to that. So, so while I say we didn't really know what we wanted to do, what I mean by that is we were trying to eschew this idea of having like one big idea, because I kind of, anyone knows from, reading literature around founders that people do something and it fails, and then you do another thing and it fails, and then they iterate a bit, and eventually on kind of like number 6 or 7, you've got something that might be viable. So we kind of knew that, so we didn't want to like ally ourselves to like one big idea. We thought, but the thing that we were really interested and kind of passionate about was, the early internet, the internet and its impact on culture from, kind of 2000 through, the late noughties. It was just really exciting. And it was, the area pre-Facebook, pre-social media, so I've seen it get referred to a bit as kind of like the indie web. So it's like, anyone with a bit of nous could publish, could curate. It hadn't been made easy enough that, your mum and your daughter could do it. But, but there was this kind of like explosion of interesting content being put out there by anyone, who felt like it, almost no cost. That was tremendously exciting. But, and this is the reason I mention it, that doesn't really exist anymore. The kind of the phase of the internet that happened, from kind of 2005, 2006. So what gets called Web 2.0 was very exciting, was very empowering. It democratized lots of these tools. It's much easier to post on Facebook than it is to set up a blog on movable type, right? But all of that got co-opted by very, very, very large platforms and companies. So the sort of the independent spirit had kind of, I think from the, so the web that I kind of knew and loved of the early noughties doesn't really exist anymore. So that's one answer to your question. Well, you're passionate about this, how do you let it go? Circumstances change, right? The sort of company that we exited looked very, very different to the company that we started. When we started, it was really around the analytics around the social diffusion of content, looking how memes and videos and ideas disseminate across culture, and particularly internet subculture. The business that we sold was, very, very interesting business, but totally different. It was, it's machines to machines, lots of machine learning. It's, much less about culture and much more about efficient trading and trading algorithms. So, we ended up in a completely different place. Also, 10 years, 12 years including the post-bac period, it's a hell of a long time. My problem was always the opposite, I'll do something, see it's kind of good enough, and I actually don't want to carry it on. I want to kind of just let someone else do that and do the next thing. So I was one of those entrepreneurs that, probably caused some harm inside the business, because I was always like wanting to I always had skunkworks projects going on because I wanted the next thing and the next thing and the next thing. And they usually wouldn't come to very much because they wouldn't look that exciting. Because we actually, by the time you've got business doing about 50 million turnover, your skunkworks projects are really hard to make them look, exciting enough on a 3-year timeline to be worth investing in. But no, my MO is always to kind of want to move on. So my struggle, honestly, was to kind of stay with a growing business and acquire some of the patience and discipline that it requires to manage larger teams of people.
So you were mildly subversive within your own enterprise. From time to time.
Mildly is probably putting it too mildly.
I think it's pretty healthy, actually. So
it didn't do any harm. It didn't do any harm.
So you're
obviously got other people who can,
restrain,
who are better, who can
keep the trains running.
Yeah, exactly.
So you're there 2 years before the board. Everyone's realized you're on the crest. Now you have to start a process. right? Boards make a decision and say, or how did that evolve?
We didn't really.
Was it less classic than that?
Yeah. So, I mean, again, I'll just give you the kind of like, you know,
The real story.
the uncoloured on this. So, it's quite hard to run a process. So, you know, so you can run a sale process, right? But if you're wanting to exit a business, you never want to run a sale process. You know, sale process, like, you know, maybe if you're larger, you can do it. If you're small and a bit under the radar, it just looks like you're waving a white flag. Right? So most bankers will say, you know, you never want to sell a company. You want someone to come along and buy your company. And there are various kind of tactics and techniques for trying to drum up interested partners whilst looking like you're resolutely not for sale. We weren't, you know, and usually they end up being people that you have, you know, reasonably large kind of, you know, business relationships. You've done some business with them before, so they get to know you. I mean, we weren't terrifically good at this. I mean, honestly, what would happen is from about, I don't know, late 2013, about every 6 months, I'd try and, you know, like we'd kickstart a project, which would be like Project X, and it would be coming in on a Saturday morning, and we'd try, like, you know, what are we doing around exit planning? Because we didn't, you know, the VCs weren't really...
Really, Project X?
Really, something like that. I can't reveal its true name. The VCs weren't really kicking us down this direction very hard. You know, they would talk about it. They would talk, you know, evenly about either, you know, exit through trade sale or IPOing, but, you know, we were always too... I mean, lots of people asked us to do IPO, but I mean, I thought we were far, far, far too small to IPO and it didn't hold much attraction for me. Anyway, so, you know, what do you do? Well, you know, we did do the sort of right stuff. You go out and you try and form, you know, strategic partnerships with the right sorts of people. It's tricky because you know, in some fields maybe there's a handful of strategic acquirers and it's really obvious. In our field, so yeah, the media companies were fairly obvious. I mean, in fact, the Googles and the Facebooks and, you know, the Apples and so forth, they don't do that many big deals, honestly, and certainly not around advertising, which is where they already have core competence. So, you know, big independent media companies, TV companies, telecoms operators. No one really believed me at the time, but you have seen telecom operators for right or wrong move into the advertising space and do some, well, you know, AT&T is a good example with AOL and yeah. Right, those are really big acquisitions. But anyway, there's a lot of companies. So you just, you know, the bottom line is the right answer is you just have to put yourself out there a lot and build profile, and you just have to get lucky, yeah? You know, so, you know, Sarah was, you know, incredibly good at kind of building the company's profile. And, you know, building our connectivity. And the News Corp conversation came off the back of a conference she was at. You know, so she didn't bump into Rupert. You know, that's not how it worked. She bumped into, you know, I think their chief data scientist. And they got on really well. And then she mentioned us to, you know, Rebecca and a couple of other people. And then it still took a few months, you know, even from then, to go from, like, initial contact to... a serious conversation. It took about 3 or 4 months, but, you know, we just got lucky. That particular conversation, that particular conference, kind of led to something, and then, you know, it's you know, at this level as well. It's as much, and, you know, this type of deal where it's you know, as much people and know-how as it is tech. You know, so much of it is just around chemistry. Really, do you get on with these people? Could you work with them? Could they work with you?
Yeah.
So that's kind of how we got there, but yeah, a little bit organically, I would say.
Question right there.
Just following on from that, did News Corp know they were looking for you when they met at that conference?
So they were looking for. Yeah, an digital advertising company. Yes, they were especially looking in the UK. They were looking more actually in the US. But yes, they were. And the investment bank that we went to for assistance with the sale, which was Lima Partners, which is a New York-based bank, did actually have a live brief from News Corp at the time to be looking for companies. Now, they weren't actually engaged, so they could do us and they weren't conflicted. But yeah, so they were looking and they were active, which I think is kind of necessary. Again, I think I was a bit naive. You think you can just you go and knock on the doors of everyone in corp dev, and eventually you find someone with the right strategic imperative. But the key thing is the exec sponsor, right? So we had two exec sponsors. We had Rebecca Brooks, who's running News UK at the time. She wasn't. She was just about to come back.
Yeah.
And Paul Cheeseborough, who was the company's CTO. So there were two exec sponsors. They wanted to do a deal. There was a corp dev team in New York that was also looking at targets and triaging stuff. Honestly, that made it more difficult in the end because there was a bit of tension between London and New York, and the New York team basically thought, why the fuck are we buying a British company? With all of the ad tech companies in New York and in the Valley, why the hell are we doing this? So there was a bit of tension around that.
Yeah, but it's interesting. Sean, we were talking before we came in. You've got a list, right? Most firms would be tracking the landscape, and they're beginning to evolve. Where what's interesting, what's emerging, what might we need. So there's a tracking activity, going on. That's why it was interesting in terms of this first conversation at the conference. What was that conversation with Sarah? There must have been some signal. Something in that conversation actually triggered an interaction that led to the acquisition. Do you remember what that conversation actually was? It couldn't have been just, let's have lunch sometime. There had to have been some catalyst in that brief encounter, some trigger that got it onto the radar screen that's a potential acquisition, or maybe, or you know what I mean?
So, that conversation was around data, around advertising data. We were doing some quite interesting things in the space around sort of emotional and psychological profiling, which is bad rep these days. But we were kind of quite early in that.
But it is News Corp, no.
And I think
So they were intrigued.
I can only speak from my own experience, but I've always found this stuff quite organic. I think the message that goes up the chain there is that these are good people. So that was one meet. Then there were some others. I met quite a few people at sort of VP and SVP level in New York, and I don't think they were particularly kicking our tires at the time, because the New York team had its they're kind of a bit more fixated on the Valley. But you meet people, you impress people, they think you're good. They kind of go, yeah, these guys are worth having a bit of a chat with. But I think it's as much that as anything.
Yeah, it's interesting.
So I don't think we were on a kind of blipping radar. No, they weren't tracking us over time. I think it was just a period when our name bubbled up quite a bit from a few different sources, and so and that got us onto the radar. But then it quite quickly became an acquisition. Well, it quite quickly became an investment discussion. It didn't have to have been an outright purchase, but investment and talks of strategic investment is often really just code for saying, yeah, we're kind of interested in buying you.
Yeah, it's interesting because a traditional, say, a VC structure, or a PE particularly, where they own a very large proportion of the business, a PE player, for example. There'll be a sale process, right? There's been no embarrassment about the fact you're selling, because everybody knows funds have to sell. So the signaling isn't the same as when you're a owner-dominated business, I suspect. Board will say, okay, let's start a process, let's put a book together. Everybody likes the serendipitous, we'd like to be approached.
Yeah.
But funds at some point do have to sell, right?
No, totally. But
so it's a little bit different in your case.
It's just, the signaling, I think, is quite tricky. Because again, so we're a few hundred staff, we were about like 40, 50 million turnover when they bought us. So quite small. The founding team is quite important. Most acquirers want to keep the founding team. If you look like you're trying to sell, you don't look like you're the sort of people who are going to stick around, do you? So, all the messaging you want to be giving is we don't want to sell, but we do think that maybe strategically this would make some sense, and we can use this as a bigger platform to do, cooler shit. That's your messaging basically, isn't it? So they're like, okay, good. So they will stick around, because that's what they're terrified about. And most of the trickiest sticking points during the negotiation was just their fear that they'd put the remit funds on completion and we would run for the hills. They're just absolutely terrified of that. And every corporate will have had examples where that has happened, or bad things have happened post-ac. There was a lot of. There are other interesting things with users. They don't do many acquisitions. The biggest one they did was Realtor in the US, and that was quite a big one. But the big digital acquisition they had done, of course, was MySpace. And although that was a long time ago, there was quite a lot of scar tissue around that. Our deal wasn't as big as that, but it was big enough to make everyone remember that and start going, oh, and we can't afford to have that happen again.
Questions, please. One back there again.
Two microphones. Fascinating talk, Scott. Probably quite sensitive, so obviously don't. In terms of you had to stay around for a few years. There's a few restrictive covenants, presumably. How did that look, so to speak? Was it I guess you understand the question, yeah.
Yeah. So roughly half of the consideration was up front, and roughly half then was deferred over a period of about 2.5, 3 years. So there's a structure created there that gives you quite a strong incentive to stick around, and quite a strong incentive to hit certain financial targets so that you can get paid. One of the things that we needed to do in terms of the exit, and I had, again, this is kind of good to know, because I hadn't really, again, this is the first proper institutionally backed exit I'd really done. The first one was too small to really factor. So when you've got deferred consideration, and there's an earn out, and there's targets and yada yada. So of course the VCs do not want to be in that. And the News Corp deal team had made it very clear from the get-go that they did not want the VCs being part of the earn-out. So we had to, and this is one of the things that I thought makes this sort of transaction difficult, because you're not just agreeing terms with your acquirer. You also then have got this really major side negotiation with the VCs that you've then got to deal with too. So we effectively, and I'm sure this is very, very common, it was just the first time I had experienced it, effectively had to buy them out of the earn-out. So on the day of completion, they got all of their money. They took a haircut on the deferred in order to be able to just walk away, and they were done. And then the rest of us were, particularly the three founders, we had our, we really had to do our 3 years. So we did less well than the VCs, considerably less well on the initial consideration. So we had much more riding on the deferred, and they had nothing riding on it, but we had a lot. So hopefully that goes some way to answering your question there.
Hi, I was wondering, during the investment round and then later in the exit process, to what extent do you keep your employees informed, and what considerations do you have?
So the investment round, yes, I think we told. So the investment round we told people quite early. Generally our kind of culture and style of communication at the company was quite open. So I think we let we would have we do all hands about once a quarter, and then we'd have a big annual get-together with everyone in the same physical location. So I think we let people know, in the summer of 2011 that I think by that time we'd retained an investment bank to work on the fundraising, but it was about 6 months before we actually did it. So we let people know quite early. The sale process, so that was tricky actually for a number of reasons. So we didn't let the company, all employees know about the News Corp deal until quite late in the day, until about 2 or 3 weeks before we announced it. Main reason being there, you're under quite a lot of pressure to avoid leaks, and news were kind of quite paranoid about that. And in fact, letting all of our employees know about, the M&A that's about to happen, kind of 3 weeks before announcement, is quite unusual. Now, we actually had to do it because we had so many employee shareholders and employee option holders. And this is one of the things the New York team, the deal team, were just totally freaked out about. So the equity structure, basically the VCs had about 25%, the founders had 50%, the other 25% was management and staff. And we had quite a lot of people, when they left, they would exercise their options and buy them, so they're actually, not just option holders, but full-on shareholders in the business. So we had, I think, of our 250 staff, 190 were option holders or shareholders. And so we knew that we would have to get written consents and paperwork off them in the sort of 2 to 3 weeks between announcing the deal and actually getting completion, which we did do. The New York team never thought we would do it, but that explains why we kind of basically, about 3 weeks beforehand, we kind of had to do an all hands and say, at which point no one was remotely surprised, because you can't really keep these things secret. So you've got this dissonance where the party line is, but you've got, News Corp folks coming in and out of the office, and then, why? And then, Rupert rocks up. Why the hell is Rupert in the boardroom talking to the founders? Oh, well, we're just trying to do, like a really important deal. So it's a bit of an open secret, I think, in those environments. But we didn't have any leaks, either pre-announcement or between announcement and completion. And we did manage to get 190 employee shareholders to all sign various things, which was a nightmare. I don't know. It had always been a really big thing, and really that we'd try and take as many people on the journey with us as possible, and that we'd have really, kind of quite significant employee ownership. And, I really stand by that. I think it's the right thing to do, and I think a lot of, particularly UK companies, are quite stingy around share-based compensation. But it was a freaky nightmare. I mean, we had occasionally ex-staff that hadn't left in, shall we say, particularly elegant scenarios, and you had to chase them down wherever they might be in the world and persuade them to sign a bit of paper. Now, if they hadn't have done, technically you don't need to, you can drag people along, you don't really technically need everyone's signature, but a corporate buy always wants everyone's signature, so they know there's no lawsuits going to kind of come out of the woodwork later down the line. And then you've got these, ex-employees who were, sales manager for 9 months, and they think they've got you over a barrel, and it's not fun. So I don't know, it's one of the things that we would think how to structure that. And if there were, I don't know, there are better structures, but...
Well, yeah, there are. I mean, you can...
Yeah, fuck you.
Well, they still make the same amount of money. Use a nominee structure. Anyway. Other questions? Yes, please.
Well, that was terrific. Thank you. So, having mentioned it a few times, you can't leave without telling at least one anecdote about negotiating with Rupert.
So we did. So I only met him, I think, once during the actual sale process. So we didn't negotiate with him. But he's, but he did sit down and grill us on the numbers, like, really quite hard for a solid hour. He is, he's a very, very, very good business person. Even though we were just like one tiny division and would see him from time to time, he had a really, really good grip on our business and its kind of merits and its challenges. And yeah, very smart, very humble.
He's taking you through the P&L rather than the strategic vision?
Honestly, both. I mean, his kind of, his grip. And, you see this in the much bigger deals he's done, recently, which tend to be him, selling off large bits of his empire. His sense, like, of where the market's going, of the forces, really, really very good. So, he was, as he always is in news, he's behind the scenes and people are talking to him, and if he gives an injunction, if he says yes or no, that's the words. If he says I won't pay more than babam, again, that's the word. It's unusual. It's a large corporate. It's public, but it's still very much an entrepreneur centric business. News. I can't speak for Fox because we didn't have very much to do with them, but certainly news. We still felt very much centred around Rupert.
So that wasn't the anecdote we were hoping for, but it was insightful nonetheless. No, that's good.
That's all you're getting.
Yes, please. A question here.
I just wanted to know how the business is doing now since the acquisition.
One of the things, we were committed to stick around our post-acquisition. You got carrots, you got sticks, but not everyone does. You don't have to. I mean, honestly, I think probably the smartest thing that an entrepreneur can do is just be really obnoxious and difficult post-acquisition, so they fire you, accelerate all the payments, and tell you to get the hell out of there. And people do that, and it's a very effective strategy. In terms of enrichment, we were quite clear that we wanted the acquisition to not be the end of the story for Unruly, and for it to be successful as a piece of M&A. And so, we all worked really hard at trying to make that happen. Now, we were lucky, because of the earn-out structure, we'd managed to negotiate quite strong operational controls. So there's quite a lot of barbed wire around the business. So, there was no integration or really much meddling for the first 3 years. So we had a lot of autonomy, but we did, we doubled the size of Unruly's business in the 3 years post-acquisition. So, it did grow. It grew in terms of staff, the technology's come on well, it started kind of, we knew we were already kind of pivoting from one business model to another, more programmatic one where you needed more scale and the margins were smaller. And that's still going on, and this is one of the key reasons that we sold at the particular time that we did, because we just knew that we needed more scale. But that's continued kind of post-ac. The bigger question, now, of course, is now that the barbed wire's kind of been taken off because the earn-out's finished, and in fact, the 3 founders are all now, personally exited the business. None of us work there anymore. What do they do next? Do they continue running it as just another, relatively small autonomous, business unit, which is what they have been doing? Do they integrate it somewhere else? If so, where? To what extent do they try to kind of leverage the data and the people and the technology across their various different kind of business units that they have in their federated portfolio. And it's not clear yet. I think they're still figuring that out. We have quite clear, we gave them quite clear POVs on that. We thought that, it really should be a centralized global unit doing, most of their digital advertising technology and deals. But news that's very countercultural from Rupert's standpoint and News Corp's standpoint. He buys companies and then they run individually, and it's really a kind of a relatively loose federation. And there is a little bit of centralisation, but not really not very much. The central team in New York is very small. It's kind of like about 20-25 people doing law and tax. And that's it. Underneath that, everything's kind of its own thing. So that, I think, is a particular challenge for them. I think strategically, probably what they would make sense is the thing that's most culturally challenging for them to do, because Rupert is quite allergic to centralisation.
We have time for one question. Who's going to ask it? Please.
Hi. Just wanted to come back to share options. I was just wondering at what point in the business you decided to do that and how you structured it, and maybe why you picked that as opposed to nominations.
So we did it immediately. The first engineer we hired got share options, which meant we did it without advice, and we did it very, very badly. And
from a tax structuring perspective?
Oh, from every perspective. It was a real mess. It was one of the things that we had to unwind and clean up before taking institutional money in 2012. So at that point, we put in a kind of quite standard options scheme across the company. Again, and that was good enough to clean it up, and it did clean it up. Probably not with enough advice, though, because the scheme that we had in place was an EMI scheme. Worked very, very well for UK employees. It worked considerably less well for people in other, different tax jurisdictions. But we had people in a hell of a lot of different jurisdictions for the size of company we were. And so, it's just one of those areas where we kind of buried our head in the sand a bit. We knew that, France probably wasn't going to look great, and Norway probably wasn't going to look great. I was surprised how bad the US looked, actually. So again, when we did exit, and all of this kind of came home to roost, so I guess in a lot of cases it doesn't, because a lot of people don't exit, right? You don't have to worry about it. So, yeah, we had to buy out a lot of people's options, actually. In fact, we did that. I think we had to do that for pretty much every jurisdiction outside of the UK. So again, it's very complicated. But so how much investment do you put into setting these things up, on day 1 or day 30?
Especially when you have one guy doing the phones. That looks like an unnecessary expense.
Yeah, true, which probably means I was doing it, which probably means I fucked it up.
Okay. Well, thank you very much. We're smack on 8 o'clock. Can we thank Scott?